Welcome to Nasdaq Trade Talks. I'm your host, Jill Malandrino, global markets reporter at Nasdaq. Joining me at the market site in Times Square, we have Jay Gragnani. He's the head of research and client engagement at Nasdaq Dorsey Wright, and we're going to take a look at using relative strength to identify winning sectors and markets with dispersions. Jay, it's great to have you with me as always. And before we get into the relative strength tools, let's take a look at what's happening in the markets right now. S&P 500, particularly after the reaction to the interest rate cut.
Well, the interest rate cut obviously coming last week, and then obviously we're here today talking about China retaliation on the yuan devaluation. But nonetheless, you're certainly seeing a spike in volatility here over the past couple of days. And I think it's always useful, especially during these times when you get a lot of this volatility, is to go back and look at some market perspective. Look at periods of time where we've seen similar type of reactions, and very particularly, specifically looking at the interest rate story. The decrease or cut in interest rates that came last week came within a market where the S&P 500 was within a couple of percent of an all-time high. Even with today's action, you're still only about 5% off of that all-time high. So that's important to keep in mind. And the reason that 5% number is important is if you go back over the past 30 years, since basically 1990, and look at every time the Fed has cut interest rates, when the market has been basically at all-time highs, so within 5% of it, that has generally been a positive thing for the market. In other words, the market has reacted positively from that point, going out 1, 3, 6, 9, and even 12 months, all showing positive average returns during those 30 years. Now, there's some exceptions in there, but if you just look on the whole, look at the averages, it has been generally positive. The periods of time where it was not was the 07 time period, where the Fed cut interest rates twice during the latter part in the fall of 2007, and obviously leading into the global financial crisis. But nonetheless, set those things aside, and when we look at the markets today, in light of the interest rate cuts, maybe there's more to come, we'll see, but when you look just historically over time, the market has been up over various time periods following those interest rate cuts coming at or very close to all-time highs in the markets.
And I think the market is going to have to come to grips with the reality that the trade war is going to be something that we need to contend with. So when you do your relative strength work at Dorsey Wright, what do the markets look like today?
Sure. When you mentioned that, the trade war has obviously now been going on for about a year. And when we think about relative strength and identifying opportunities, what we want to do is identify leadership areas of the market. Which areas, whether it be asset classes, sectors, or stocks, are showing the greatest potential to outperform. And U.S. equities for the past 3 years now, and for a bulk of the past decade, have been that place. That has not changed. U.S. equities continue, when we look across broad asset classes, continues to be the number one ranked asset class. Market environments where relative strength tends to do well are environments where you get large dispersions amongst whatever it is we're evaluating, whether it's sectors, whether it's stocks, whether it's asset classes. And just this year, through Friday, if you look just at the broad sectors, so not even drilling down and getting real granular, but just broad sectors, there's over a 20% dispersion between the best and the worst performing sector just this year. Technology being the best, as well as technology continuing to be the strongest from a relative strength perspective. And then down at the bottom, you have healthcare and energy basically tied for the bottom there. You look at that on a stock basis as well, and there's over 70% dispersion between the best performing and the worst performing stock just amongst the top 50 names. So the top 50 market cap stocks. So even within large cap equities, you can get a lot of dispersion, or have gotten a lot of dispersion so far this year. So that's when you tend to see relative strength analysis tend to work well, when you have those big dispersions in returns, and that's where relative strength can identify those leadership opportunities in the market. With that said, I mentioned technology, still the strongest sector, and growth in general still out there. Obviously, a lot of that stuff is pulling back here today and over the past couple of days, but still sitting there at the number one. Utilities and real estate are in there as well in terms of leadership sectors of the market that we're looking at, with utilities being number two. And the last one that I'll mention, the one that has really come on here recently this year, has been precious metals, whether it be a flight to safety for gold, precious metal stocks in general doing well, but precious metals has also moved up that spectrum.
All right, we already spoke about interest rate cuts and the trade war concerns. What other headwinds does the market face right now? And of course, seasonality has to be one of them.
Seasonality is always one, especially as we enter August. We're now in the back half of what's known as the seasonally weak period of the market. So August historically is not a great month for the market. I think if you look back over the past 30 years, it's the 10th out of 12 best performing months, so not very good. September historically is the worst performing month. That's coming up next month. And then October often brings with it a lot of volatility as well. So the next 3 months, just from a historical seasonality perspective, is a period in the market that has historically not done very well. Another thing that we're looking at pretty closely in terms of things that would concern us a little bit would be our bullish percent indicators. And if you're not familiar with bullish percent indicators, it's simply measuring the percent of stocks within a given universe that are on a point and figure buy signal. In other words, percent of stocks that are being controlled by demand in the marketplace today. When you look at those charts, we're seeing, like for the S&P 500, the bullish percent for the S&P 500 has reversed down to create a lower top. That comes as the S&P 500 index itself has recently moved to a new high. And so the long and short of that is, when we look at the bullish percent indicators today as a measure of breadth or participation in the market, we haven't seen as many stocks participating in the recent rally to new highs as we did earlier in the year. That's a little bit of a concerning sign, a situation that we'll continue to watch unfold and evolve from here. But if there's one thing that is of concern to us from our market indicator perspective, it would be those bullish percent charts.
All right, and you know what, 70% of S&P 500 stocks still remain in positive trends today as well. So there is some light at the end of the tunnel if you have a longer term bullish view on the market.
That's right. Yeah, from the longer term relative strength, as we mentioned with our Dolly or asset class rankings, U.S. equity still number one. 70% of stocks in the S&P are still in positive trends. The bullish percents would be more shorter term in nature, suggesting that what we could see a little bit more downside, but we haven't seen a trend erosion or deterioration there just yet.
All right, Jay, thank you as always for joining us at MarketSite. And thank you for joining me on Trade Talks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.